Good morning again. So from the presentation today, right, I mean, what we are really trying to cover is trying to understand the supply landscape a little bit and try to get a feel for where oil and gas markets are headed going forward and talk a little bit in terms of some of the broader issues that we see in and around gas monetization. We are hoping that we'll leave you with 5 key messages. The first is something that I think is fairly well understood and established, but essentially there's a significant amount of natural gas resource that's available in North America. And a lot of the gas that's available now, the production of that is independent of gas pricing. To a large extent, gas pricing doesn't matter to that production anymore. Operators will continue to produce those volumes of natural gas irrespective of what the natural gas price is. So we'll talk about that a little bit. Second key message, the cost reductions that we have seen in unconventionals continue at a very robust pace, and we anticipate those cost reductions to continue over the next several years. And we'll look at how breakevens are further improving because of these continuous cost optimization that unconventional oil and gas operators are working on. So, one of the questions that a lot of clients ask us, especially when we're doing feasibility studies, is in terms of how much natural gas is available, at what price is that available, and is there enough volume to justify projects that have lifetimes of 15, 20, 25 years. And I think the short answer to that is yes, there's plenty of natural gas resource available. We think that there's close to 1,500 trillion cubic feet of natural gas that's available, and a significant chunk of that is available at prices less than $3 a million BTU. We think that less than $3 a million BTU. And we'll talk a little bit more about what that supply curve looks like for natural gas production and how much natural gas is available at different price points. In terms of where that supply is coming from, Appalachia leads the outlook in terms of natural gas supply and production. That has been the dominant producer of natural gas over the last few years. We expect that to continue as well. Permian is contributing an increasingly larger share of production towards overall natural gas supply. Some of that is driven by the fact that operators in Permian are producing natural gas not because they want to, but because they're being forced to, because their primary objective is oil production. And then lastly, we see a lot of opportunities in the gas monetization landscape even now, although we do feel that the first wave of some of the best opportunities has kind of passed in shale 1.0, if you will, essentially in terms of all the projects that have been conceptualized and implemented over the last 5 years. So let's talk a little bit more about some of the resource base that's out there. I mean, every year, whenever an agency goes out and looks at the natural gas resource, they come up with a higher number. And essentially, the overall natural gas resource base has been increasing. One of the things to keep in mind is that a lot of the underlying assumptions for some of these estimates for the natural gas resource assume 3 to 5% recovery factors for hydrocarbons. If you go to conventional oil and gas resources, recovery factors are anywhere from 15 to 35%. Now, some of the higher recovery factors are based on things like enhanced oil recovery, tertiary recovery mechanisms. So there's a lot of room just in terms of boosting the recovery factor for unconventionals. So I think a lot of the estimates that you see in terms of what the overall resource base looks like will be much higher if we think that there is further progress in terms of boosting up that recovery resource factor. So depending on who you talk to, right, you'll get fairly wide-ranging estimates for oil and gas production going out in the future. In general, all of those estimates are fairly bullish and optimistic. Last year, the U.S. produced a little short of 9 million barrels per day of crude oil. It came down a little bit from 9.1, 9.2 in 2015, primarily as a function of what has happened to oil pricing. But going out over the next 10, 15 years, people think that anywhere from 10 to 12 million barrels per day of oil production from unconventionals in North America is fairly realistic and possible. In terms of natural gas supply, last year we were a little shy of 70 billion cubic feet a day. Going forward, the numbers are anywhere from 100 to as much as 120, 125 BCF. The estimates that we have are more on the conservative range based on what EIA thinks is going forward. A number of other estimates have been published that suggest the numbers can be much higher. So a significant fraction of the natural gas that we are producing today is independent of gas prices. What we mean by that is that natural gas is being produced not because operators want to produce it, but because it's a byproduct of oil production. They are going after oil, and as a result, they're getting a little bit of gas, and they have to do something with it. So to a large extent, the break-even rates on such oil and such gas production is actually are actually negative numbers, right? I mean, you are essentially getting, for all practical purposes, without a cost associated with that production. And then, of course, the remaining production is coming out of places like Appalachia, where the break-even costs are fairly small and fairly low. So in terms of what the outlook for oil and gas pricing looks like going forward fairly quickly, like with oil prices at any point of time, I think there's a fairly broad range in terms of what the outlook for oil prices looks like. We always do this chart where we put the historical price of oil on a spot basis, and then we kind of put together what the range of the different forecasts by different people who are active in these markets looks like. When the price of oil is good, what we find is that range tends to be much broader and of course much higher. And when we are in difficult times like we are in today, what we find is that range tends to go down and also tends to get narrower. So I think we see some of that in oil and gas forecasts at this point of time, which is that the general consensus is that oil prices will probably be in this band of anywhere from $50 to $60 over the next 6 to 8 quarters or so. But there are a couple of people out there who do think that things can get pretty difficult and oil prices can fall to as low as $20. And some of the underlying assumptions for the downside case are that the OPEC deal falls through and brings more supply or continues the large volumes of supply that we have seen over the last few years. I think a more concerning point that from our point of view is the ceiling that we see on oil prices at this point of time. If you look at the, let's say that 2/3 or 3/4 of the unconventional oil production in North America right now, that production is economic at somewhere around $50 to $55 in terms of break-even costs. So essentially what that means is every time the price of oil reaches $50, $55, maybe $60, a lot of that production gets turned on. And once that production gets turned on, that supply comes into the market, and it's difficult to find a place for that supply. And essentially, prices start responding again back down to the mid-50s. So essentially, our view, our working model at this point of time is that the OPEC deal, if it goes through, essentially all that it does is it provides a floor to oil prices. And North American shale is acting as some sort of a ceiling. So unless there is some major geopolitical disruption or there is some rapid growth in economic activity amongst emerging economies, it's unlikely for us to kind of come out of this bandwidth of $50 to $60, $65 over the next 4 to 8 quarters in terms of oil prices. Most of the industry has kind of reconciled with this view and has made a lot of operational changes that focus on responding to that change and to that bandwidth in the 50s. But for the gas conversion and the gas processing industry, that bandwidth is still fairly difficult to justify a lot of projects. And gas prices have to be a little bit higher in order to justify some of the gas monetization, gas commercialization projects that people have been talking about. So anyways, given this scenario, right, I mean, I talked a little bit about this, but the industry has kind of reconciled to this view, and they have started spending some CapEx back again. So if you see the CapEx reductions that we saw following the fall, following 2014, a couple of difficult years, and then slowly we are seeing a little bit of growth in terms of activity. We are clearly quite away from the growth rates that we saw in the early part of this decade, and we don't think that CapEx is going to come back up until the 2020s at the levels that we saw earlier. Talking a little bit in terms of gas prices, we think that gas prices are at historical lows, and I think it'll be difficult to sustain natural gas prices at these historical lows going forward for multiple reasons. First, I think the capital investments that the industry has made over the last 5 to 8 years in gas commercialization, gas demand projects are actually coming on stream right now. A lot of that capital is coming into, is being effectively put to work right now. And so demand will pick up slowly, and that will have an impact on price. And so that will drive some prices up, but only by so much, because unconventional costs are falling. Marcellus Appalachian production is fairly robust. So there's still a lot of supply that's available. So the thing is that in 2016, the average price was a little over $2.50. When you look at the curve, you can see that we might expect something like a 50% increase in prices on the low case, down to a little shy of $3.50. But even if you assume that there's going to be more demand and more natural gas exports, we think that at best prices will probably stabilize a little under $4.5 a million BTU. So let's talk a little bit about where this gas is coming from, what do the costs and economics of some of the supply look like, and where are unconventional costs headed. In general, we think that the competitiveness of unconventional gas production is only going to improve further. There's more room actually for that reduction. Last year, we spent a lot of time working with operators on trying to understand the cost curve for unconventionals, and our team did very tedious work looking at 4 of the major plays, understanding the entire breakdown of an unconventional oil and gas well, component by component, and trying to figure out how costs have actually evolved over the last 5 years. And we have some of that data on this particular slide here. So, we looked at 4 plays, as I said, Bakken, Eagle Ford, Permian, and Marcellus. Gas is being produced from all the plays, but let's focus on Marcellus because that's where the bulk of the gas production today is coming from. And you'll see that drilling costs, so this is just drilling, right? The cost it takes to drill a horizontal hole right down before you actually complete it. Drilling costs in the Marcellus have fallen by as much as a third over the last 5 years. Now, if you compare that to some of the other plays, the Marcellus drilling cost reductions have been the most aggressive relative to some of the other plays that we have seen. So now if you look at the view for completions, right, which is once you drill the hole and you complete the well, you fracture it and start production, you see a similar story. Marcellus kind of leads in terms of the cost reductions that operators have seen across the different plays. And again, Marcellus completion costs are about 30% of where they were 5 or 6 years back. So fairly impressive, fairly significant cost reductions. And a lot of the data that we are showing here is normalized data. So it's not actual total well cost, but it is actually well cost by some normalized metrics. So in this case, it's actually dollars per lateral foot that you are actually completing. This is important because well costs are actually rising. If you look at well costs from 10 to now, well costs are higher, but it's higher because the newer wells are much more sophisticated, much more complex relative to the earlier generation of wells. So a lot of these cost reductions have come from a number of things, right? I mean, the operators have been very effective. These operators have realized that if you're going to go out and drill thousands of wells, we might better get very efficient with it. And we have seen new technologies, better workflows, improved processes that are being deployed across the value chain, right? So if you take a typical workflow for an unconventional oil and gas well, you go from exploration, drilling, completions, down to production, and you look at the different workflows. All of those are tools or techniques or new processes that the unconventional operators have developed or deployed over the last few years. Not all of them are necessarily new technologies. They're just better improved ways of doing things. And some of those are shown in that blue color relative to some of the other initiatives that are probably more new processes and new technologies. So clearly, right, I mean, you saw that there has been significant cost reductions, but going forward, we anticipate that this pace of cost optimization, this pace of cost innovation will continue. What we have on this page is just some of the key cost components on the left side, drilling, completion components, and that include fluids, proppant, and pumping. And then what we have done is we've just qualitatively shown what the historical trend has been across the 4 plays and what we see as the forecast in terms of the same 4 plays. And what you'll see is that there's a lot of room and opportunity for further cost reduction. So when you go and talk to unconventional oil and gas players, right, they'll tell you about how they're talking about engineered completions. They'll tell you about how they are improving the rate at which proppant can be injected downhole. They'll talk to you about how they are injecting less water to get higher yields. A lot of that is what the industry refers to as engineered completions. And collectively, all of that is essentially going to increase production, well productivity, and reduce overall well costs. So moving on to quantify some of this in terms of what the exact volume of natural gas resource looks like, how much is available, and where that is headed. So at a high level, right, that's the supply curve for natural gas in North America. Based on the different plays. And this is what I was referring to earlier. All these negative break-even numbers are essentially gas production that is independent of gas pricing. So essentially, you are producing that because you're producing oil. And so to a large extent, the break-evens of that are based on where oil is rather than on where gas pricing is. So the interesting piece here is that if you look at where the bulk of the production is, you'll see that a significant chunk of the production breaks even at less than $3 a million BTU. So if you then correlate that to what actual demand looks like, let's say for the next 15 years or for the next 25 years, what that tells you is that you can, from a fundamentals point of view, assume that for the next 15 to 25 years, you can secure gas at less than $3 a million BTU. So from a planning point of view, as you are looking at projects, as you are conceptualizing ideas and you're thinking of what is the feedstock cost that you can assume on a Henry Hub basis, right, assuming that you can get gas at $3 a million BTU is not a bad assumption. So one of the things is if you go to certain parts of the country, like if you go to northeastern Marcellus, where there's a significant amount of gas that is landlocked, you can get that gas at even lower prices than that because there's not enough pipeline connectivity. There are a lot of producers there who are not operating, and you can get gas at as less than $1 a million BTU. So I think these low natural gas prices, right? They offer a lot of options in addition to the fact that they make interesting economics for new projects. One interesting thing is as natural gas production has grown, and so that's the yellow line, and that's here in terms of billion cubic feet per day. CO2 emissions have actually fallen, right? So essentially, a lot of this is happening because the U.S. is utilizing increasing volumes of natural gas, which is a lower carbon feedstock relative to, let's say, other options. And that just provides a lot of policy options in terms of what you can do with natural gas. So for example, right, if we do a couple of thought experiments, right, and we assume that, let's say we are headed towards a low carbon future, right, where the Clean Power Plan is implemented, where the Paris Accord is implemented, and coal loses further share, that has significant implications in terms of the outlook for natural gas. That will drive natural gas demand fairly quickly. Now, on the other hand, if you assume that we are headed towards a minimal carbon limit scenario, and we drop some of these regulatory initiatives, the outlook is not very good for natural gas. We found that this analysis is somewhat counterintuitive to what a lot of people expect. And the reason is because in an environment where there are not enough limits that are being imposed on carbon, existing assets, whether they are coal-fired assets or other natural gas-fired assets, will be pushed harder. You will operate them for longer periods of time. You will squeeze out more value out of those assets. And that will delay further capital investment in natural gas-fired assets. So essentially, you are in some ways curtailing additional demand for natural gas in an environment where there's not enough restriction on carbon. So I think this is important because there are fairly important policy implications that are available because of the access to large volumes of natural gas that are available in the US right now. So in terms of new production, right, I mean, we've talked a little bit about this, but Appalachia and Permian kind of lead the supply surge here. So if you take a look at the US map, and hopefully that's showing through, but it's probably not showing through very clearly on this side, but that's the US map. And if you look at the incremental production that's coming out over the next 5 years, Marcellus and Utica are going to lead with almost a little 15 to 20 billion cubic feet a day in production, followed by the Permian at about 5 BCF a day of production. So where is all of this production headed? So a lot of that is going to be exported via LNG through the Gulf Coast. We think that anywhere from 9 to 15 BCF per day of production or gas production will be exported out of the US through the Gulf Coast, some of it through the East Coast as well. And then, of course, there'll be local consumption that happens in the Midwest markets. And then finally, there'll be further growth in pipeline exports. We anticipate a significant amount of natural gas finding its way in Mexico as well as Canada. And the later talks will go into more detail into what is driving this and what the specific outlook looks like.
Uday, I thought that I haven't seen maps like this before. 8 BCF a day coming from the Northeast to the Gulf Coast. Mm-hmm. That just seems like it's going the wrong way.
Well, based on...
we're going to reverse those gas pipelines? Is that what that means?
A lot of that has already happened.
Yeah, I know. I just don't know.
Yeah, I mean, a lot of that has already happened, right? A lot of the gas that traditionally went to the East Coast is now actually coming back because of the Appalachian production.
But I mean, they're not reversing gas pipelines. Well, this is just what we used to send up that's not going now.
That's not going anymore.
Okay.
So just wrapping up, the last point that we'd like to make is there are lots of gas monetization options out there, and there are lots of opportunities to benefit from this natural gas resource base. And I think what is important is to kind of look at what kinds of opportunities are available. I mean, if you take natural gas and you see what you can do with it, you can do a bunch of things. I mean, you can take natural gas, use it for power. You can use it for LNG, of course. You can convert it into chemicals, fuels, other chemical products. You can use it for in transportation either as LNG or CNG. So there are lots of options that are available in terms of gas monetization. Likewise on NGLs, right? Lots of options there. So in terms of the solution set, there's no dearth of opportunities in terms of what you can do with natural gas. The challenge is how do you make the economics of a lot of these projects work? So when you look at what has happened over the last 5 years in terms of the overall attractiveness of the various gas monetization options, I think it's easier to see what has happened historically, as always. Clearly there's been a lot of coal that's been displaced for power generation. We've seen what has happened to large-scale exports. We've seen a lot of investments that have been made in methanol. Some of them are moving forward, not all of them are moving forward. Similarly with ammonia, I think ammonia, the picture is a little more difficult than it is for methanol. And then finally in the transportation space. So we think that these are the best opportunities, but like in any market, the best opportunities are for early movers. Not every player is going to have access to those opportunities because at the end of the day, markets are limited by demand, right? There's only so much demand for LNG, there's only so much demand for methanol. So I think while these are fairly attractive opportunities, the first wave has kind of passed and projects that are in place today are going to benefit from that, but new projects here will probably struggle. So what are the opportunities available for the second wave, if you will? And the second wave in terms of opportunities is more of these, but at much smaller scales. So we think that distributed generation has interesting opportunities. We think that small and mid-scale LNG projects are interesting. We think that if the technology improves, then opportunities around small-scale methanol, small-scale gas to liquids would be fairly interesting as well. So there are lots of opportunities, but I think a lot of these require further innovation, further technology development going forward. So we'll talk very quickly about 3 specific opportunities in a little bit more detail.
Were those previous slides referring to domestic activity in America or globally?
No, domestic activities primarily. Now, so for example, LNG, right, the market may be overseas, but the idea is to liquefy it here in North America. So if we talk a little bit about 3 specific opportunities that we see in the market today, right? We think that these are good opportunities for people to consider today. The economics make sense today. One is in mid-scale LNG, the second small-scale LNG, and the third, interestingly, in refining for high-octane gasoline blend stocks. So we'll talk a little bit about why we see that. So at a high level, right, if you look at the global LNG market, what is happening is there is a significant amount of disaggregation of demand growth that's happening in the LNG market. And my colleague Tyler will talk a little bit more about this later. But if you look at the traditional LNG market, right, it was dominated by a few countries, Japan, South Korea, and a few other players who imported large volumes of LNG through long-term contracts, and they dominated the market. But if you look at what has happened, right, there have been a number of new players that have entered the LNG market. These are companies that are importing relatively smaller cargoes of LNG, and we see that only increasing in terms of smaller countries importing more LNG and in smaller volumes. So collectively, what that means is that we're going to see demand for smaller scale LNG projects, not necessarily small scale, but smaller than the traditional large scale LNG exports that we have seen historically in the LNG industry. So we actually, our analysis suggests that there's significant demand for mid-scale LNG capacity on a global basis, and some of that will grow going forward. Similarly, I think we see new markets and opportunities for small-scale LNG. There's regulatory pressure on marine fuels that people are using for shipping, and because of those regulatory pressures, people are looking at replacing heavy fuel oil with cleaner fuels, and LNG is one of the options that our shipping operators are considering. We think that there'll be growth there, and as a result, there'll be more demand for small-scale LNG capacity going forward. So, which is, sorry.
Small scale, mid scale, what is the range?
So, small scale is anything less than 1 million tons per annum, and mid-scale is 1 to 5 million tons per annum. Now, that's how we are defining it, right? It's just an arbitrary definition. So given all that, right, we see a lot of activity in terms of small and mid-scale LNG projects in North America. What we have on this chart is just a sample of some of those projects. We spend a lot of time benchmarking the various projects that have been proposed out there in terms of projects that are actually going to move forward versus projects that are probably going to stay as press releases. So some of that benchmarking is reflected here. We like a few projects. One of them, of course, is already moving forward. Another is fairly close to completion. So I think now we definitely don't want you to suggest that we don't think that none of these projects are going to move forward. Some of them will likely move forward, but in general, there's a lot of factors that need to be addressed for some of these projects to move forward. So I'll just wrap up with
Are these all or most associated gas? There wouldn't be any on-purpose gas, small-scale LNG, would there?
Yeah, I think so. I think in many ways, right, that model has changed significantly, right? I mean, traditionally the model was that you would take a gas resource and monetize it by building an LNG plant. I think, and Tyler will talk a little bit about that later, but that model has completely changed in North America. People no longer view LNG as a way to monetize natural gas resource in North America. People view LNG as a way to fulfill market demand because there's so much gas that's available. So the last thing that I want to leave you with in terms of opportunities is around how the shale production can help with a fairly important problem that the refining industry is facing today. So if you look at the value of an octane barrel, so this is the dollar value of a barrel of gasoline that has 1 octane point higher than the comparative barrel that you're looking at, right? Or I guess a simpler way to look at it is when you drive up to the gas station, you see 3 grades of gasoline. It's the price differential between those 3 grades of gasoline normalized on a per octane number basis. So that has risen significantly over the last few years. This is surprising and unexpected because if you look at ethanol blending, that has been at near all-time highs. Ethanol is a very high octane blend stock. When ethanol blending was first introduced or first mandated, people didn't expect that they would be struggling for octane. But octane is a significant problem today in the refining industry, and a lot of that is tied to the light tight oil production. The US refining industry has ramped up significantly its diet of light tight oil that it's using for processing. And the issue with light tight oil is that it doesn't have the high octane components that traditional crude oils have. So essentially, these are the 2 factors that are driving some of the deficit in terms of octane value. And then the third thing is that the US demand for gasoline has risen fairly quickly, either through exports as well as domestic demand. So collectively, right, I mean, there is a shortage in octane, and the question is, how do you fill that shortage in octane? And we think that there are opportunities in the midstream part of the gas and NGL processing part of the value chain in order to fill that gap. So it's a complicated slide, but let's walk through it, right? I mean, this shows, the chart on the left shows gasoline imports by PADD into the US. So historically, right, I mean, 10 years back when I got into the consulting business, if someone had asked me how much gasoline do we typically import, I'd have said 1 million barrels per day, and I'd have been right for most of the time. So that has changed significantly, and right now we are only importing about 1 million barrels per day. Now, if you take the same, 500,000 barrels a day, a little over 500,000. If you take those imports today and break it down in terms of what actually that is in terms of finished versus blended products, what you'll see is that most of it are gasoline blending components. So these are alkylates, isomerates, these are blending components that you blend into gasoline in order to get certain RVP specs, certain octane specs. And interestingly, a lot of that is coming into PADD 1, which is the East Coast. And interestingly, East Coast is where there's a significant amount of NGL production that is stranded or not getting enough adequate pricing or demand. So what do you do with that? So conceptually, you can take that NGL production and build on-purpose alkylation units, dimerization units, leveraging midstream infrastructure facilities, and then just blend it into refiners on the East Coast. And I think there are a few companies that are actively looking at some of these opportunities, but this is a way by which we can take a significant amount of relatively underutilized natural gas resource that's available in North America and convert it into components for which there is strong demand and commercial opportunity. So with that, I'll wrap up again, just at a high level, some of the 5 key messages that I'm hoping will stay with you from the presentation today. We think that there's a significant amount of natural gas that's available out there that can be brought to market fairly quickly. A lot of that gas production is independent of gas pricing and is tied to oil pricing. We think that there are further cost reductions and further cost optimization that can happen around drilling and completion costs in unconventionals. Third, assume that you'll have gas for the next 25, 30 years at less than $3 a million BTU. We think that is supported by fundamentals. Fourth, a lot of this supply is coming in from the Appalachia. And finally, we still see opportunities in the gas processing value chain, although some of the best opportunities may have passed in that first wave. So thank you for the interest and the attention. Happy to take more questions.
Yeah, you mentioned possible on-purpose alkylation. What about MTBE, ETBE, DME for export outside the U.S.?
So yeah, I mean, I think so. There's a lot of MTBE that's already being exported right now for outside, for external demand. You can't use it in the U.S. So I think we might see more opportunities around that, but given that you can produce methanol fairly cost effectively, given that you have C4 streams that are fairly cheap right now, there's definitely opportunity and room there. The only thing is that unlike, let's say, some of the other gasoline blend stocks, there are the demand for MTBE is somewhat limited, right? There's only it's still a small market relative to, let's say, gasoline blend stocks.
Sure. Why do we still have the rule against MTBE in the United States when everywhere else is used?
Yeah.
I mean, because the rules can change, why would this one not change?
I mean, it could change, but it's highly unlikely, right? I mean, the experience that California had with MTBE leakage through the gas stations and the impact that it had on drinking water, I think some of those are hard to overcome.
Who would be the champion for that?
Other people, all the people who built MTBE plants that just shut it down.
They won't be very persuasive.
Yeah, Uday, we have a question over here.
Yes, you mentioned 75 BCF is the average production in the U.S. Does that include only monetized gas, or does it also include flared gas and gas reintroduced into the formation? And if that's separate, how much flared gas is there that you could estimate as being burned today?
So the 72 billion cubic feet a day that we have is what is referred to as dry gas production, right? I mean, so you're actually producing probably 30% more, but it is being consumed or being re-injected back because of various reasons, right? In terms of what is being flared, the bulk of the flaring was happening in the Bakken. About 30% of gas was being flared in the Bakken a few years back, which we're going to talk about it a little bit later in the presentation, but I forget, but Tyler, we are at like what, 12% right now. So that has come down quite a bit, and we are now a little more like 10 to 12% in terms of the Bakken volume that is being flared. And the Bakken volume is, I think, a billion. We need to get the numbers, but we'll get you the numbers, and you'll also see a little bit more of that discussion later.
Okay, one more question here.
Have you looked at the balance sheets of some of these producers on getting the gas out of Marcellus onto the pipelines that are coming up, like Rover and Nexus? Are they going to be able to supply that?
I think the On the supply side, I'm not too worried about it. On the midstream side, there are lots of challenges, right? Because there's just, in general, there's a surplus of pipeline capacity, right? And what midstream operators are finding out is that it is difficult to, during open season, to kind of get enough interest to kind of fill out the pipeline capacity. But on the operator side, I mean, clearly there will always be operators that are going to struggle and are going to fall off the supply curve. But there's still a lot of operators that are doing fairly well in the Appalachia. I mean, Antero, for example, is one of the largest operators in the Appalachia, and every year they cut costs out of their operations. So I think there's still a lot of room and opportunity there.
One question?
See, you talked about a little bit about 3 scenarios for carbon abatement and natural gas use, right? So, but there are many projects that are already in the works to shut down the coal plant. They're not easy to bring them back up again.
Yeah.
So given that, don't you see a spike in natural gas usage?
Actually, so actually not, and we'll talk a little bit about this later today. But the thing is that, yes, a lot of coal-fired capacity is going out. Well, 2 parts, right? A lot of coal-fired capacity has already gone out, and some more is going out. If let's say the EPA today drops the clean power plan, we don't think that a lot of coal-fired power plant capacity is going to come back up. But what we are saying is that the existing coal-fired power plants that are out there, people will run them harder. They will run them more intensively. Yeah. So that'll lead to a little bit of. So I think one of the key insights for today is actually around gas-fired power generation. So I'll leave that message for our colleague Elliot Smith, who's going to talk about that.
Do you also see the replacement with renewables, quite a bit of that, right? So there is every state and every utility is committed to certain amount of renewables usage now.
Yeah.
What's the effect of that on natural gas?
So I think we'll talk about that as well in a little bit. So I guess just hold that thought, Murthy. More is coming down the pike.
Okay, very good. Yeah, thank you.
Thank you, Ron.